Tom, thanks for being with us again to talk about trends in the economy. Today, we're going to ask you to focus on monetary policy and changes that are happening in that area. The Federal Open Market Committee's just had its September meeting. We're hoping you'll dissect that for us and talk about implications for borrowers here in the U.S.
Great to be with you, Arthur. I look forward to the conversation.
So let me start with an observation and get your reaction to that. The Fed, ever since the pandemic started, the Fed has basically been acting as though the U.S. economy is a patient on life support, just massive doses of monetary stimulus in order to keep the economy on track. When you look around, however, especially over the last couple quarters, the last several months, the performance of the economies actually seem to be very strong. Growth has rebounded, unemployment's come down, asset values are rising, et cetera. So the audio and the video don't seem like they totally match up. And I guess first question for you is, do you agree with that? And if you do, why do you think it is that the Fed has been so cautious about pulling monetary stimulus back?
We're in a place that is completely different than I expected us to be at this time, i.e., we have inflation, for one thing, more of it than anyone expected. We have an unemployment rate, which we'll talk about, which is much lower. We have growth on a tear. And you're right. So you look at some of those factors and others, and you look at the continued monetary stimulus, and you go, wow, why are we continuing to do this? And I think, to be fair, it's the worst global health pandemic in 100 years. And so knowing exactly what to do or exactly how it was going to manifest in terms of its impact on the economy, and thus, what tools are the right tools and what combination in which to use them between fiscal and monetary policy is really, really hard. And the Fed is also constrained by decisions that they took a little while ago, since we hadn't had inflation and couldn't seem to get inflation in this country. And they just decided a little over a year ago that they were going to wait to see inflation and to see it go above 2% for a while before they acted, right? So they're still in the early process of establishing their credibility for that framework. And therefore, they are waiting to see enough evidence of macroeconomic strength before taking steps to start a path of reducing monetary stimulus and increasing interest rates.
Let's bring up a chart that reflects this dynamic. This shows change in U.S. GDP going back to 2000, so a 20-year time horizon, including it on the right-hand side here, the Fed's updated projections for growth, not only for 2021, but the 3 years after that through 2024. You can see they're quite strong and they're significantly above the average for the last 20 years. Again, when you look at this, what's your reaction to this chart, and how surprised are you with these updated projections?
On the one hand, I'm not surprised. I expected the economy to, fall off a cliff and then have a huge bounce back, right? We are having those things. But what's surprising to me is the magnitude of the bounce back is bigger than I kind of anticipated. And some of the attributes of the bounce back are a little bit different. I have been on the road of late, and I've talked to probably 50 CEOs of customers in the last couple of weeks, and I get told continuously the stories that people are and experiences people are having running their business. It's not just an inflation issue. It's I can't get this part to keep my factory line running. I can't get workers and employees. I can't get fill in the blank. So the economy is on a tear. We have a lot of growth now. While it may be uneven, a lot of parts of the economy, particularly the customers and industries that we serve, are doing really, really well.
Let's bring up another chart, this one showing employment. Same basic idea here, but again, when you look at those projections out from the Fed for unemployment in 2024, 3.5%. The average unemployment rate over the last 20 years is like 6%. So again, just very, very strong projections in terms of the job market.
A year ago, maybe more, you and I were having a conversation very like this. We were looking at the Fed's then projections, which looked like the middle of this graph, i.e. they were thinking unemployment wouldn't come back to pre-COVID levels for a decade, or at least in the 5 to 10 year period. But we're going to get back to those levels in a couple of years. And frankly, in many sectors of the economy, there just aren't enough workers, right? And there's just multitudes of examples of that, right? The number of open jobs is pretty similar to the number of people out of work. But a lot of those people who are out of work aren't really actively looking for employment. So we have a situation where labor constraints and the pricing power of labor in the equation for businesses is stronger than it's been anytime, frankly, since I graduated from high school. And that's showing up as an inability to get labor at any price in some cases, and wage inflation, which, even though it's starting to manifest, is still lower than inflation, the monetary phenomena itself, which is spiked in aggregate, but in certain commodities or certain sectors, meaningfully more than the national average.
So let's pivot now to specific monetary actions that the Fed is looking at going forward, and have you talk about those and what they mean for borrowers. So this chart shows the balance sheet of the Federal Reserve over the past couple of years. You can see the huge increase that it undertook at the start of the pandemic. Just for the non-monetarists in our audience, explain what's happening here. What's the Fed been trying to accomplish, and what are they likely to do going forward?
The big thing that they're trying to accomplish is to be supportive of macroeconomic activity at a time when we've had a massive external shock to the downside caused by the pandemic. And what the Fed was trying to do was to keep interest rates low and use the levers and tools in their toolbox to keep interest rates low. Some of that manifests as them being a buyer of assets in the capital markets. They buy assets, they show up on their balance sheet. That's one of the many attributes of the kinds of things that they have done. Now, we've all known that the pandemic won't last forever. So the question from a monetary policy perspective is when and how and at what speed do we ease off on all of those monetary stimulus measures? And that's what watchers of the Federal Reserve, like ourselves as bankers, are trying to figure out. And it's getting a lot closer as we sit here talking.
So when the Fed starts to adjust what it's doing, how will this chart start to change? And more importantly, when is this going to happen?
They're going to start the quote unquote tapering process in November in the absence of some unexpected negative shock. So that should be our going in assumption and understanding. What that means is the pace at which they are buying assets to show up on their balance sheet will start to taper off, and eventually they'll stop. The growth in assets on their balance sheet, the size of the Fed's balance sheet will stop growing, but they're going to continue to reinvest those proceeds. So we should not expect this to go into reverse and start to shrink anytime soon. That'll be a longer term phenomenon.
So let's bring up the next chart, which illustrates another thing that the Fed controls, which is the federal funds rate. And there is this thing called the dot plot, and that gets watched very closely. But they revised their dot plot in September from where they were in June. That's shown here. Talk about what this shows and why it's important.
Well, obviously, the dot plot is just the manifestation of the opinions expressed by the members of the Federal Reserve Board, and it gives you some indication of what they think is going to happen in the future based on the decisions that they will have to take. What we experience is the fact that they too see all the data that we're discussing here today, and they can see that their unemployment's lower, GDP growth is higher. Supply side constraints in the economy are more common and manifest and severe than maybe they expected, certainly than I expected. And as a result, they're expecting, therefore, that short-term interest rates that they control are probably going to go up faster and earlier than we had previously expected in the last version of their dot plot.
So the last chart here and the last question, the Treasury yield curve as of today. What do you see here, and what are the implications for people who might be thinking of borrowing money for whatever reason?
Well, having been an observer and participant in the capital markets and the financial services industry for all of my career, I look at today's yield curve and I say, wow, money is cheaper than it's ever been in my life. It's never been a better time to be a borrower, right? Whether you're a consumer or a business, money is effectively free in real terms. And it's a pretty unusual set of facts and circumstances. I don't think, money's going to become significantly more expensive, tomorrow, next week, or even when the short-term interest rate movements start to occur. These things are going to play out over a long period of time, and the shape of the yield curve will evolve. But I think we're going to continue to be in a really low interest rate environment for quite a long time.